Hello everyone, I'm Kapches, President of Chestnut Park Real Estate, and today I'm going to be providing you with the June market report for the Toronto and Toronto region. I begin this report by talking, of course, about the rate cut. Bank of Canada reduced its benchmark rate by 0.25% in June. Incredible anticipation for the rate cut, but at the end of the day, it really didn't have much of an impact on the market. In fact, there was an economist who used the expression that the 0.25 rate cut was like taking a butter knife to a gunfight. That was the effect of the rate cut. Clearly, we need much more than a 0.25 rate cut to really move the meter on the resale market. We certainly didn't get it in June, although the bank did indicate that the economic circumstances are such that probably more rate cuts will come as the year moves on. First of all, the rate cut wasn't enough, as I said, to move the needle. But secondly, because it wasn't enough, it had actually a debilitating impact on the market in that it immobilized the buyers, immobilized them because they are now waiting to see what the bank does the next time, because currently the impact was insignificant. The bond market, mortgage markets had already built in what they anticipated would be the bank's rate cut, and as a result of that, there was hardly any change in the mortgage rates, the 5-year fixed-term rates, and as a result, there was no help to buyers and consumers generally as a result of the bank's very minuscule rate cut. So what did that do to the market? Well, what we discover in the market is that in June we only had 6,213 sales. That was a fairly substantial decline from last year, over 16%. Last year there were 7,429 sales. So we clearly did not move in the direction that we wanted to. Should also be kept in mind, though, that we're getting into a seasonal period. Generally, as you get into June and the summer months, the market slows in any event, but that rate cut certainly didn't help. And as a result of that, we're sort of struggling with a sluggish market in June. Sales dropped across the board, whether you're looking at detached properties, semi-detached properties, or condominium apartments. But the biggest hit in the marketplace were condominium apartments. They declined by 28% compared to last June. That's a big number year over year for the decline. And of course, they declined because they are the most price sensitive, financially sensitive. Because of the cohort of people that normally buy them, first-time buyers, people that have constrained economic means. The average sale price only $727,000 across the GTA for condominium apartments. But if you're struggling and you have a household income that is struggling with the economic circumstances, you're going to find it difficult even to get into the market at $727,000. The average sale price overall seems to be defying gravity. In fact, from the beginning of the year until June, it has continued to increased by more than 13% since the beginning of the year. And in June, it came in at $1,162,000, slightly less than what it was last year, but still a pretty lofty number. And I think the reason for that is sellers are holding their prices. They're anticipating that the market will improve, and as a result of that, we're not seeing prices decline in order to meet the buyer demand. However, since sales were not as robust as we would have liked them to be, we have seen substantial increase in inventory levels. In fact, to levels that we haven't seen for some time. Even pre-pandemic, we were averaging 2018, 2019, somewhere around 20,000 odd properties available for sale. In June, that number jumped to 23,600 plus properties for sale, starting to get to pretty lofty numbers. Just in June alone, there were 17,964 new listings. If we compare the number of active listings in June compared to June of last year, it's an increase of almost 68%. It's quite an increase in the number of listings out there, and that in turn makes it a little surprising that in fact more sales haven't taken place, and from the other perspective, why prices haven't drifted down. But they haven't. They've stayed strong, and it looks like they're going to continue to stay strong. And as I mentioned a moment ago, they have continued to increase from the beginning of the year to where we find themselves now. I should mention that in terms of the number of listings that are out there, more than 8,000 of them are condominium apartments. So a huge number of listings are condominium apartments, which, as I mentioned a moment ago, are not doing that well, a decline of 28% year over year. And that's another reason why the overall numbers are not looking as good. But it has to be stated that both in the case of semi-detached and detached properties, they too declined year over year in the month of June. The interesting thing is that those sales that did take place in June, as far as semi and semi-detached properties are concerned, really took place in a very robust fashion. For example, all detached properties in the city of Toronto sold in only 15 days on the market, and they sold for 101% of their asking price. What was the asking price? The average sale price came in at $1,758,000 for a detached property. Similarly, and even more dramatically in the case of semi-detached properties, they sold in only 10 days for 105% of their asking price. And the average sale price came in at $1,282,000, almost $1.3 million. So how does one reconcile what's happening with respect to detached and semi-detached property sales, the overall market, and condominium apartments? Well, as I mentioned a moment ago, the cohort that is looking to buy condominium apartments are the most price sensitive and financially sensitive. Clearly, what the sales of detached and semi-detached properties indicate is that the demand remains strong out there, and those people that can afford the lofty prices for detached and semi-detached property, they did so. They stepped up very quickly, as I said, in 15 days in the case of detached properties, in 10 days in the case of semi-detached properties, and paid over the asking price. Problem is, there's not a lot of people that fall into that category. Affordability is impacting them, as it is impacting the lower end of the market, namely condominium apartments. So that's what unfolded during the month of June. We look ahead to July. What is going to happen in July? Well, the Bank of Canada is going to be meeting on July the 24th. Clearly, the real estate market, in order to pick up some steam, to become a little bit more robust, is going to need a fairly substantial decline in the Bank of Canada's benchmark rate. Another 0.25% reduction is not likely to move the needle dramatically. It might be a little bit more dramatic than taking a butter knife to a gunfight, but still not going to move the needle a lot. As we were preparing for this presentation, we got the latest employment figures, and somewhat shockingly, the unemployment rate went up again. We're now at 6.4%, which is the highest that it's been in about 2 years. That probably is going to have an impact on the Bank of Canada when it meets on July the 24th, and it may result in a benchmark cut that is lower than 0.25%. If that happens, we will probably see the market start to pick up, because that will have an effect on affordability, which is the major problem holding the market back now. And then we'll probably see a much more robust August, and then definitely a much more robust second half of 2024. So until we have the July numbers, which I'm looking forward to presenting to